Welcome to the deep dive. Today, we're jumping straight into Q1 fiscal 26 for a tech giant. Massive cloud and AI surge, but also some serious forward guidance. Capacity is the word.
Yeah, absolutely. And an exceptional quarter really signals that AI monetization, it's happening way faster than maybe anyone thought.
Okay, so let's get right into those Q1 FY26 headliners. Revenue, $77.7 billion. That's up 18%.
Impressive jump. And operating income, $38.0 billion, up 24%. Even better.
Right. And the non-GAAP EPS, this is the one excluding those big OpenAI investment impacts, $4.13. That's a 23% increase.
And it's important, to remember why they adjust that. Those OpenAI investments are strategic, they're huge, but the core engine.
Microsoft Cloud.
Exactly. That's roaring. Cloud revenue topped $49 billion, up 26% or 25% in constant currency.
Okay, the cloud is the engine, definitely. But the number that really jumped out, I think, defining this AI demand. Commercial remaining performance obligation, RPO, nearly $400 billion, up 51% year over year. I mean, just massive.
That $400 billion, it's critical.
Yeah.
It tells you something fundamental is shifting in how tech is bought. Think about it.
Go on.
That balance, the RPO, it's basically doubled in just 2 years. Doubled.
Wow.
But, and this is key, the average contract duration.
Yeah.
Still stable, right around 2 years.
Wait, so if the total value doubled, but the length is the same, what's that mean? Are you just signing way bigger deals?
Yeah.
Or using it faster?
It's kind of both, really. Bigger deals, yes.
Yeah.
But structured for, immediate consumption. It's not the old model, signing a 5-year deal to lock rates.
Right.
Now it's huge commitments, nearly $400 billion. But the message is, we need this compute now. It's this urgency for AI access.
That urgency explains the bookings then. Commercial bookings up 112%. I mean, that just crushed estimates.
Absolutely crushed them. Driven by huge Azure deals, especially, tied to OpenAI, and also way more of those really big contracts. We're talking $100 million plus deals.
It feels like huge validation for their whole AI strategy, doesn't it?
Totally. It shows the massive CapEx, the money they're pouring into infrastructure. It's not just speculative. It's translating immediately into these giant short-term commitments.
Yeah, demand is clearly running ahead of supply.
That's the definition of it.
Okay, speaking of supply, let's hit the segments. Intelligent Cloud, the heart of it all.
Right. So segment revenue, $30.9 billion. That's up 28%.
Solid. And inside that, Azure and the other cloud services
Grew 40%. Or 39% constant currency, huge number.
40%. But there was a pretty big caveat attached to that, wasn't there?
Oh, absolutely. The story there isn't just the 40%. It's that management straight up said demand for Azure AI services exceeded supply, even while they were adding capacity like crazy.
So they're literally selling out as fast as they can build it.
Pretty much. It's a constrained growth situation.
Okay, so that's the pressure point. Let's look at where that capacity is going. Productivity and business processes. Revenue up 17%. This is the Copilot effect, right?
Yeah, definitely. This segment, the growth driver, is increasingly ARPU, average revenue per user.
Getting more from existing customers.
Exactly. M365 commercial cloud revenue up 17%, led by things like E5, that's their top security and compliance tier, and crucially, M365 Copilot.
And the adoption speed for Copilot. It's apparently faster than any other new M365 suite launch ever.
It is. And you can see why when you look at the impact. It's not just a feature. It's driving real productivity.
Yeah.
Take Lloyd's Banking Group.
Okay.
They rolled out 30,000 seats. They're reporting savings of 46 minutes per employee per day.
46 minutes.
Yeah.
Daily. For 30,000 people, that's enormous.
It's a massive ROI. That's why you see companies like PwC jumping in so aggressively. They added 155,000 seats just this quarter.
Wow.
And their employees hit Copilot over 30 million times in 6 months. That kind of usage, it just validates the whole approach.
So it's way past the testing it out phase. 90% of the Fortune 500 using M365 Copilot now.
Yeah, the signal is incredibly strong. And it's similar in the developer space too, right? GitHub Copilot.
The AI pair programmer.
Most popular one out there. Over 26 million users. And get this, 80% of new developers start using it in their first week. It's becoming like table stakes.
Okay, so all this demand, this usage, it leads directly to the spending, the CapEx.
Exactly. Capital expenditures hit $34.9 billion this quarter. Just driven entirely by this cloud and AI demand.
And there was something specific about what they spent that CapEx on, wasn't there? Something about short-lived assets.
Yes, that's super important. About half of that $34.9 billion went to GPUs and CPUs. They call them short-lived because the tech cycle for these AI chips is just incredibly fast.
Meaning they become outdated quickly.
Right. A top chip today might be significantly outperformed in, say, 18 to 24 months. So unlike buildings or cooling systems that last years, this core compute hardware needs constant, rapid refreshing.
So the huge spend isn't just building more, it's constantly upgrading the engines inside.
Precisely. And they're just getting started, really. They announced plans to boost AI capacity by over 80% this year.
80% this year.
And double the total data center footprint in the next 2 years. It's a generational build-out.
A massive undertaking.
Right.
And that brings us to OpenAI, their key partner. The new deal includes another $250 billion contract for Azure.
Yep. $250 billion.
Yeah.
Locks in a huge chunk of demand for all that capacity they're building.
Validates the spend, like you said.
And deepens the partnership. IP rights, API exclusivity on Azure extended to 2030 or until AGI. And the product IP rights go even further to 2032.
Okay, $250 billion is huge. The IP rights seem solid. But locking in with one foundational model partner until 2030, doesn't that create a dependency risk?
That's the strategic gamble, isn't it? On one side, guaranteed access to top-tier models.
Right,
reduces their own R&D risk, maybe. On the other, yeah, big dependency.
But the product IP rights.
That suggests they're integrating it deeply into their stuff. Copilot, Agent HQ, gives them more control over the final product that customers actually buy. They're betting that tight integration and guaranteed supply outweigh the risk.
Okay. Demand. Huge. Investment astronomical, capacity stretched. Which makes the forward guidance for Q2 really interesting.
Yeah, because the demand signals are apparently accelerating even faster than they expected.
So Q2 outlook. Total revenue strong, $79.5 to $80.6 billion. That's 16% growth.
Good top line. But look at the cost of goods sold, COGS. Expected to jump 21% to 22%.
Driven by
AI infrastructure. Building that factory, it hits the cost immediately.
Which impacts margins, right. Operating margins expected flat year over year, down from Q1. Some seasonality, sure, but mostly that CapEx spend.
They're prioritizing capacity and market share over immediate margin expansion. Makes sense given the demand.
And for Intelligent Cloud specifically, revenue expected $32.25 to $32.55 billion.
Still incredibly strong. And Azure growth projected around 37% constant currency for Q2. Phenomenal.
But caveat remains.
The caveat remains. Demand is significantly ahead of capacity. They expect to be constrained through at least the end of this fiscal year, FY26.
And that constraint isn't simple. They're juggling, right? Allocating scarce AI compute.
Exactly. Balancing Azure for external customers versus their own needs, Copilot, internal R&D, even just replacing older servers. It's tough choices about who gets the best GPUs first.
You can see how serious it is because they raised the CapEx forecast again. Spending even more in Q2, and FY26 CapEx growth will be higher than FY25's.
They are absolutely sprinting to catch up to their own success, basically.
So pulling it all together, this quarter seems to prove that AI investment is paying off in huge near-term commitments, that $400 bit RPO.
Right. The whole debate shifts, doesn't it?
Yeah.
It's less, are they building the right thing, and much more, can they physically build it fast enough?
And thinking longer term, management had an interesting comment about jagged intelligence in the models.
Yeah, that was fascinating. The idea that LLMs can be brilliant at task A, but pretty bad at task B. High peaks, deep valleys.
Uneven capability.
Right. And they argued the real value isn't just the raw model, it's the agent system built on top. Things like Copilot, Agent HQ.
The layer that organizes and smooths out those jaggy bits makes it reliable for business.
Exactly. It orchestrates those capabilities, turns the raw, sometimes erratic intelligence into something dependable and useful across different tasks.
So the ultimate edge might not be just the smartest LLM.
It might be more about who builds the most efficient token factory, the infrastructure, the CapEx story, and who builds the best organizing layer, the agent system, the Copilot story.
Interesting. So maybe a final thought for you listening is the real AI competition shifting. Less about the core model smarts and more about building the most efficient production line for AI compute and the smartest system to actually manage and deploy that intelligence for customers. Seems like the focus is moving from the lab to the factory floor.